Mike Verity, and I'm the Chief Investment Officer here at Lighthouse Financial Services. I'm going to deliver another edition of our market update. Show my screen here. Okay, April 2024. It's been a little over a month since I was in front of you with my last update. Here are our talking points for today. We'll look back at the rally that we've experienced, especially since Halloween, which has been very nice. Stocks and bonds, although stocks have done better, and we'll discuss why. We'll discuss again the rate debate. Is inflation reaccelerating? And is that going to prevent the Federal Reserve from cutting interest rates? The thing that we've all been waiting for. And then we'll discuss the economy. What does the landing look like? And the Fed's sort of balancing act between inflation and growth. And lastly, I'll start talking about earnings, which I think will be a lot more important than the Fed as we move toward the middle and latter part of 2024. Okay, so here we go. You've seen this chart before. I call this the new bull, and I've been calling it that for the last year. You'll see at the left-hand side of this chart, just as a review, there's the 34% bear market correction that we had during COVID. Very quick downdraft, but also have an equally quick recovery. And when that gave way to a roughly 18-month massive 100% plus bull market rally, well, that seemed great, and it moved us to new all-time highs in the stock market. But we had a problem. We had a really high inflation, and it really alarmed the Federal Reserve, who started raising interest rates to kill that off. And that led us into the 2022 bear market, which bottomed in October of that year. And since then, we've seen a new bull market, and it's been uneven, but it has been a move higher. And there have been significant corrections like last fall. But I'll point you to the right-hand side of this chart. Since Halloween, we've had a huge move in the stock market to back to fresh highs, and maybe it's time for a little correction. So that's the hook down you see at the very end. It's our view that this correction is routine in nature. Remember, you typically get a 5 to 10% correction once per year, and this could very well be it. Maybe investors are a little bit spoiled because of what's happened in the last 6 months, but that's okay. Get a little correction and we can move forward. The bond market, I think, is still kind of trying to find its footing. And Halloween also marked a bottom in the bond market. And this chart shows you one of the widely held bond funds here in the US, the aggregate. And it includes municipal bonds, corporate bonds, treasury bonds, all of them, junk bonds. So the aggregate tracks sort of how bond prices are doing. And while bond yields are pretty high, right? Even short-term bond yields are 5%, a little bit over that maybe. Bond prices have really kind of struggled, and the reason is that we're trying to find sort of normal or neutral ground. Where are interest rates supposed to be? And I think bond traders have second guessed the Federal Reserve and what the Fed intends to do with rate hikes or rate cuts, and they've gotten it wrong a lot of the time. So bond funds are still struggling, not as positive as the stock market. So let's discuss a little bit more in depth about why that is. I want to show you the Fed funds interest rate. This orange line is the rate that the Federal Reserve gets to set unilaterally. And you can see that based on high inflation back on the left-hand side of this chart, they started to stair-step interest rates up from nearly zero back in March 2022 to over 5%. And then they quit raising last fall or summer, and they just have sort of kept interest rates at a higher or what they call restrictive level since then. But the blue line here, the 2-year Treasury note yield, Well, that yield is not determined by the Fed. That's determined by bond traders and investors. And they keep second guessing the Fed. You know, is the Fed going to keep raising? Are they going to hold neutral for a while? Are they going to start reducing interest rates, and when? And so that's why the blue line is not an even stair step up and then straight across. It's all over the place. And again, traders are just trying to figure out what's the Fed going to do next. They're trying to predict that, and it hasn't really worked out. So we got a big move down in interest rates last winter, and now they're kind of coming back up. So we'll talk about why. The primary reason is inflation. You know, the Fed wouldn't have taken interest rates up to 5+% if inflation had been normal, but it wasn't normal. Coming out of COVID, all of that stimulus really helped cause the worst inflationary crisis since the 80s, the early 80s. And so this shows you consumer price index in the black. That's a very closely watched measure of U.S. inflation, and also the core in blue, which just excludes food and energy. But I want to focus on the black and the red. The red is the Federal Reserve's target, and they want to bring inflation down to 2. That's what they say is normal. I take issue with that. I think if you look back long term, multiple decades back into the past, you find that inflation can find a normal level at 3. And I'm wondering if maybe the Fed's going to have to change that or go soft on that 2% target. But at the moment, that's what they say they want it to be. And the black line, while it was making great progress through the mid part of 2023, has really sort of kind of stalled out. I mean, we're not making much more progress on inflation. The CPI even ticked up to 3.5% recently. And so I think there's a little concern out there in the investment community and among the Fed officials that maybe we're not making the progress on inflation that we need to make. And that's a problem. It's not a deal killer, though. What I want to focus on now is Fed messaging. The Fed back in December said that they thought inflation was on track to be well in hand, and so they might as well start thinking about lowering interest rates. You know, why would you do that ahead of time? Well, because interest rates are at restrictive levels, and when you bring up interest rates from a very low level to a restrictive level, you can cause real havoc in the economy. So they are aware of that, and they're watching that. But at the same time, the Fed messaging now this week has changed, and they say that the recent data have clearly not given us greater confidence that inflation is coming under control. So a little bit of a pivot here by the Federal Reserve. That is making us wonder if they're going to be able to lower interest rates this year. Let's take a look at lending rates, by the way, because I said, you know, when you keep rates at a high level for a longer period of time, that can cause problems in the economy. And I think intuitively you can see that here. Look, a regular 30-year fixed rate mortgage a year ago was 6.93, and now it's 7.41. Not the highest it's been over that last 12 months, but still 7.41. HELOC moved from 8% to 9% in that same period. Credit card, new offers for people with good credit moved up about 3.5 percentage points just in the last year. So look, it's pretty clear that if you keep interest rates at a restrictive level forever, you are going to cause problems in the economy. Eventually, probably those issues could cause a recession. So far, they have not. But this is the Fed's dilemma. Can you bring inflation down to acceptable or more normal levels by cranking up interest rates just high enough and for just long enough to kill inflation without killing the economy? Or do you make a policy mistake? You keep interest rates too high for too long and cause a recession. That is the balancing act that the Fed is dealing with. Now, they got one ace up their sleeve, here, and that is the economy has actually done really well, far better than most expected. And I want to show you this chart. This is from the Wall Street Journal, and it's based on a survey of economists that they do periodically. The black line in this chart is just the actual growth of the US economy. And they call it GDP or gross domestic product, but whatever. It's just economic growth. The black line is what we actually experienced. 2% is considered long run good, healthy. And you can see that that black line has remained above 2% since, well, the beginning of this chart's what, the fourth quarter of 2022. Okay, but what are all these other dotted lines? At each point along the way, at each quarter along the way, beginning in the fourth quarter of 2022, we have the actual number on the black, but we also have forward expectations that are pulled by the Wall Street Journal, all these economists out there, people smarter than we are. And I want you to notice that all of these paths, these dotted paths, are down sharply. And yet the black line, as we move through the quarters of the chart, the black line stays above 2%. What this is telling us is that economists, even now, are expecting a slowdown at each quarter, and it still hasn't come. In fact, you can see that it goes negative in the middle of that chart. The expectations are that we should have had a recession. We did not, okay? So every step along the way, economists have been incorrect in projecting a downturn. And it's the same thing with the job market. So the prior chart was the overall economy. This is the job market, and then specifically the number of new jobs that this economy is creating every month. Same thing though. The black line is actual and it never dips below 200,000, but you see all these dotted lines going back in time. Economists expected a sharp fall off at every month or every quarter, and they're just not getting it. Still expecting it though. You see the red dotted line. Still expecting that, okay, this is it. No more strength. We're going to lose momentum here. It just hasn't happened. Number of reasons why. I think we've had a flush of immigration that has kind of helped prop up the job market, and also worker productivity has increased. Also, and you've heard me say this many times, we experienced a lot of shocks and distortions because of the pandemic. Global supply chains, I think employment patterns, and those are two big ones. And we're just getting over those. And this is where we said 2023 was a year of sort of normalcy, creating normalcy again. I think this year is a year of growth. Now we've got our footing and we can move forward. And yet, as you can see in these last couple of charts, economists are still expecting maybe not a downturn, but definitely a slowdown. And that brings me to this slide, and you've seen this slide many times. And I've titled it this time, "Where is the landing?" Okay, so let me go back to the Fed's balancing act, right? They want to raise interest rates high enough and for just long enough to kill inflation, but not too high or too long to kill the economy. So in that balancing act, there are 4 outcomes. And the best is at the left here, no landing, and the worst outcome is the hard landing at the right. And the hard landing would include, pretty severe recession. Whereas the no landing sort of says, well, the economy just keeps chugging along and inflation falls to an acceptable level, and we really don't see any negative effects from this, from the Federal Reserve having raised interest rates so high. You notice at the bottom here, I've added a new graphic, and it's backwards. I know 2022 is at the right-hand side of the chart. It's because in 2022, most investors and economists thought we were going to have a hard landing. And as we progress through 2023 and into the spring of 2024, I think the consensus expectation has shifted from hard landing to bumpy landings to soft landing to there is no landing. I mean, you remember that chart. I'll go back to it. Economic growth still hasn't fallen below 2% in any quarter, for the past year and a half. So I think the moral of the story is worst case scenarios were built in that weren't realistic. And, you got to be data dependent in this scenario. This has been a great time to be invested. Okay, meanwhile, and can we stop talking about the Fed and interest rates? Another really positive development has occurred over the past 12 months. This chart smashes together the 500 biggest publicly traded companies in the US, and it shows their profit expectations going forward. Okay, look, if you're a stock investor, what do you really care about? Do you care about the next election? Not primary importance. No, what you really care about is, are American companies generating sales growth and profit growth? That's what we really care about. If you look statistically back in time, the single best explainer of stock market direction, up or down, or individual stocks direction, is, can they generate profit growth? So this chart mashes together, like I said, all 500 largest US companies, and it measures their profit expectations going forward. You can see the left-hand side of this chart. In the late 2022 and early 2023, analysts and economists were taking down profit expectations because they expected that recession to come. They thought the job market was going to sort of fall apart, bunch of layoffs, and there would be a recession. But over the last 12 months, this line has been moving higher, as I think everybody's realized gradually the worst case scenario is not happening. And so here we are today, and we're out of the earnings recession. In other words, year-over-year decline in profits is a thing of the past. That was a 2022, 2023 issue. And now, I won't say we're off to the races, but we're expecting positive growth that's supposed to build through the year. And it is true that we are already seeing signs that many US companies are enjoying a higher profit margins, which is great. Coming out of COVID, again, I talk about pandemic-related distortions. A lot of companies saw lower profit margins because of issues with the labor market, snarled global supply chains, and strange and radically shifting demand patterns from their customers. So I think we're out of that, and that's why I believe 2024 is sort of a year where we build on, we've already achieved normal, sort of, and now we build on that and can grow. I want to just point out that first quarter earnings season has just kicked off, and that's just roughly a month-long period where publicly traded companies in the US are required to notify their investors how they did in the prior quarter. And one of the key things they also do during these announcements is they also sort of look forward and say, here's the trend we're seeing now, and we'll extrapolate that forward and tell you what we think is going to happen in this current quarter and maybe for the rest of the year. It's early on, okay, and I won't say everything's been uniformly positive, but I picked out 4 companies that have already reported that had something interesting to say, caught my eye. Morgan Stanley, heavily involved in capital markets, investing, wealth management, investment banking, securities trading, and they said that those businesses are rebounding, especially when it comes to investment banking. They say they're in the early innings of a multi-year M&A cycle. Not only M&A, which is mergers and acquisitions, they're a consultant, and they help companies figure out, where they should try to acquire growth. And also, they also said that IPOs are starting to come back. And when you see IPOs coming back, that means that risk appetite's coming back among investors. It means the companies feel a little bit better about their immediate future, so that they can start spending money on buying other companies or going public and taking some financial risk. This is a good sign. The next one is Bank of America, and this is CEO Brian Moynihan was interviewed yesterday. He said loan growth is muted. He admitted that, and the reason, of course, is that we have higher interest rates, higher lending rates, but credit quality is still good. In other words, we haven't seen a massive wave of loan defaults, foreclosures, bankruptcies, that kind of thing. Consumer spending he said it's growing at a slower pace than it has like a year ago, down to 5% annual rate spending. But he said that's great, that's healthy, and it's consistent with pre-pandemic levels. Again, we've found normal. United Airlines, I won't call this demand normal. I think it's pretty strong. The CEO said that demand continues to be strong, and he sees record spring and summer travel coming up, record levels, and expects that he'll see his 11th highest sales days in the history of the company all this calendar year. And then finally, CSX, the railway transportation company, seeing favorable trends in most of their markets. Growth is not sort of off the charts, but shipping volume is expected to grow roughly mid-single digits this year, and that's good, that's decent. So in other words, there's some growth I think we can build on here. And maybe, one last thing, maybe is this the year when we have to start fixating on every word and every interest rate tick from the Federal Reserve, and we can start focusing on growth, focusing on how companies that make up the stock market are actually doing? I think so. I think this is that year. Next time we'll talk about how earnings season turned out. We'll get the bulk of that done, and should be about a month. Here are some disclosures if you want to watch them, but thanks for watching. Appreciate your attention, and we thank you. We'll see you later. Bye-bye.